Good morning, everyone. My name is Sarah Bettridge, and I wanted to welcome you to the first part of our Investor Readiness program. These webinars form part of the Investor Readiness program, which BDO is doing in collaboration with the Department of Primary Industries and Regional Development. In addition to the webinars, we are providing 4 practical masterclasses in Busselton and Geraldton, which will be running in the months of April to June this year. The registrations for these masterclasses will be coming out shortly on Eventbrite, so make sure to look out for them. Additionally, there will be online resources released during the program period, which will be available on the Department of Primary Industries and Regional Development's website. These documents will assist you in becoming investor ready and navigating the capital raising process, so be sure to look out for these also. Throughout this 3-part webinar series, we will be discussing the main key elements of investor readiness, which can be broken up into 2 parts. The path to becoming investor ready, and then the path to navigating the capital raising process once you are ready. Todd Grover will be presenting this webinar, which covers off on navigating the capital raising process once you are considered investor ready. By understanding what the end result looks like, you can assess what stage you're at and what gaps need to be filled. Danny OLSEN will be doing the second webinar, which will focus on getting you to the capital raising stage and filling in these gaps. Lastly, we have Margot Beauchamp, who is demonstrating the implementation of this process with a live client case study. If you have any questions about the program, please reach out either to myself or the Department of Primary Industries and Regional Development. I will now pass you on to our expert in mergers and acquisitions, Todd Grover. Todd has worldwide experience in mergers and acquisitions and has spent the last decade transacting in mid-market businesses in Western Australia. During this time, he has been responsible for sourcing and securing transaction mandates and facilitating transaction negotiations on both the buying and selling side. Without further ado, I'll hand you over to Todd. He's going to educate us all on maximising your investor readiness.
Good morning, everyone. Nice to be with you this morning. Looking forward to presenting you with this webinar. I guess one of the big challenges to start off with a webinar is that it's not hugely interactive, given that we're all sitting here in a room looking at a computer screen rather than your faces. So there is a chat function, question function on your little login thing there. So please feel free at any point during the presentation to jump in and say a few words or ask for clarification on something or whatever it is that you're thinking about. Happy to hear it as we progress. We'll try and make this webinar as interactive as we possibly can. All right, so as Sarah alluded to, today's webinar is technical difficulties. First page, maximising investor readiness, presented by myself, Todd Grover. So a quick overview of this session for you guys. First thing is, we are doing this in conjunction with our friends at the Department of Primary Industries and Regional Development. As you can see from your screen, I'm just trying to move something out of the way. Their role is to help people and create jobs and improve career opportunities in regional Australia, and looking to broaden and deepen the economic base of the region and the regions, Western Australia, promote and develop within the regions, and with particular focus on WA agriculture and food businesses. So during this presentation, we'll try and tie back some of the materials to examples in and around the agriculture and food industry in particular. A little bit about what I'm hoping you guys get out of this today. Objectives of the session. So things that that I hope that you can do at the end, and if you can't, then obviously this is not working, but hopefully it is. So what we're looking to get is identify the key elements of investor readiness, and to describe and understand the differences between selling a business and raising capital, which are 2 very distinctively different concepts. So we'll walk through those. How to answer the questions that matter to most investors in general. So again, we've tried to distill down what is a rather tricky topic into something which is quite straightforward. Let's see if that works. Understanding the key documents that support a capital raise. So interestingly, A lot of people say, I need a business plan, I need a model, I need various other pieces of material, but that's sort of the outcome, not the thing, the primary thing at the start. The actual primary thing is to understand what needs to be said, and that is why you have those materials. So we'll delve a little bit deeper into that. Also, there's more than one way to finance investor readiness and to get investment. That's through equity or debt. Pros and cons of both, and we'll talk a little bit about sources of those and some of the reasons why you might consider either or. All right. So Sarah did give me a lovely introduction, but I thought I might slightly embellish on that. There's a picture of me, or what I used to look like when I was thinner and younger. So if you get to meet me in person, it's not quite as good as that, and that's been photoshopped quite heavily. So yeah, not quite right, but close enough. You'll hopefully recognize me if you bumped into me. So I'm a partner here in the corporate finance team at BDO. My specialism is mergers and acquisitions. So prior to being here, I actually had a practice that I started with a couple other individuals that specialized in mid-market M&A called Tompkins Turner, and we sold that to BDO in late 2017. Prior to that, I worked in London, worked for some large corporates and also in banking for 4 or 5 years. And prior to that, worked for one of our larger competitors, both here and on the East Coast. So I have been doing this for a little while. We pulled up a couple of transactions there just to give you some idea. One was a trade sale, one was a capital raise, which again, both concepts will allude to today. The trade sale was one we finished, it was the last deal that I closed with my team, which was a business on the East Coast actually, ComSec, which looks after the prison phone system for about 50% of the Australian prison population. And we sold it to a company out of Hamburg in Germany, which was good fun. But just to illustrate that expertise, so to speak. And the other one was a couple of years ago now. Minivair was a mining technology business. And the reason I put that one there that I liked about it was a combination of 3 shareholders where one shareholder exited. We did a convertible note to bring in some debt, and we raised capital from 2 different private equity firms, one of venture capital, one of private equity. So pretty much every possible combination of what you could do from a capital raise point of view in one transaction, which is a little bit unusual, but again, evidence of what we've done. And interestingly, Viburnum is a West Australian-based private equity firm, of which there aren't too many, so that was good. BDO, if you haven't heard of us, we are a large global accounting firm, as well as other different streams of professional services. We're around 80,000 people in 160 countries with $9 billion of revenue. So hopefully that all leads to, my next point was, all of that was just basically say, hopefully I have some credibility to help guide you guys through this topic today. Okay, information over. Let's get into it. So Sarah alluded to another presentation that we have, our next presentation, which is slightly different, which is around the cornerstone elements of investor readiness. And I guess in some ways I'd consider these hygiene factors, so to speak, sort of what aspects of your business you need to have under control so that you can actually move into this phase, which I'm going to talk about today, which is investor readiness. So these are really the aspects of making sure you've got a good business. So the first element, business and strategic planning, what are you focused on today? So just to have a good understanding of what your business actually is today and how it works and operates. Some basic financial acumen. So everybody loves clean financial books and records. Tax people, investors, everybody, owners, make sure that your books and records are in good shape. Otherwise, we're not building on a solid foundation when it comes to these next steps that we'll walk through today. Legal, again, there's lots of different structures you may or may not be operating from, be it a sole practitioner through a partnership or a company. Some are a bit more receptive, or investors a bit more receptive to some of those structures more so than others. Good to understand that you have a structure that somebody can actually invest into. People, again, right people in the right roles is really important. And processes. So around your policies, procedures, your systems, making sure everything is documented and good to go. So that there's a very quick overview on what the next presentation will be on, the next webinar, which is in around about 2 weeks' time, which one of my colleagues, fellow partners, Danny Olsen, will run through. All right, just checking, has any questions popped up on the screen in case I missed them? Don't think so. So we'll continue on. So far, so good. Okay, so, oopsie, the next section is attracting investment. So broadly, we'll cover selling versus raising capital, 4 key questions for an investor, some of the key documentation that we need to prepare to support those questions, sources of funds, and then finally we'll have a recap at the end. All right, selling versus raising capital. Fair bit of crossover, but actually remarkably different. So we're just going to walk through how that is different. So the first one is selling equity, or effectively selling your business. So typically when you're doing that, you're looking for a buyer for your business, and typically that's someone that is strategic or trade-based. So if you have a business that's doing, let's take it back to agriculture, it might be the family farm. A strategic investor may be your next door neighbor. That's somebody who has something, understands your business quite intimately. They'll buy your business and then you will exit from your business to somewhere else doing something else. Typically, these sort of acquisitions are 100%. They may not necessarily be 100% cash on day one. There may be some structuring around that, or it may be up to 100% over a point in time, over a period of time. But effectively, it's a sale of a business, 100%. When it comes to acquisition rationale, somebody usually makes a decision about buying your business based on what they think they can do with your business. So it's very much about them and what they want your business for. So let's try and contrast that against the alternative, which is the focus of today, capital raising. So investor type, we are talking more about financial investors. Individuals, it could be private equity, it could be venture capital. They're people that are coming to the table with cash, and quite often they bring skills or expertise or experience to complement your business, to invest in your business and help it grow. And principally, that means you are hanging around. The acquisition quite often is not 100%. It can be anything from a small minority to a majority, but again, you're typically hanging around. And the best way to think of it is more as a partner rather than a buyer or an investor. It's somebody you're bringing into your business that you are going to be working with. And then the final piece is what motivates that person. What is their rationale for investing in your business? So that comes a lot around. We've got here investing focused on supporting your vision. So basically, they are funding your story. They're funding your plan. Yeah, it's not what their plan is; it's what your plan is, which is the distinction. So yeah, high-level overview, very simplistic, but just to give you some ideas on the differentiation between selling versus raising capital. And today, we're talking raising capital for investor readiness. All right, so that's all well and good. Let's move on a little bit. Technical difficulties. All right, back on track. 4 key questions an investor will ask. So again, we're taking a rather complicated topic here and trying to distill it down to something which is quite straightforward. Let's see how we go. First one is, what does your business do? Clearly, you need to be able to explain to someone what your business does and what your basic plan is. I'm skipping through these quickly because we're going to go through them in some more detail, but let's just put them out there. Question number 2, how much money do you want and what are you going to do with it? Pretty self-explanatory. Third one is, what do I get? So really important, what's in it for me? And then finally, when do I, the investor, get my money back? So quite often a financial-based investor is looking at this as some sort of return. So they need to be able to crystallize that at some point in the future. It's really important to have that concept in your mind. Investors want to know how they're getting out before they get in. All right, so let's dig a little bit deeper on each of those 4 topics. clearly defined responses and supporting materials, something that we'll be going through. All right. What does your business do? Okay, as I mentioned, it sounds quite simple, but it's actually a little bit tricky. One of the things I wanted to bring your attention to today, and there's a little video here which I'm going to run, if I can make it work, is to understand your why rather than what your what is. So the two big why question is, what is your purpose? What is the problem you're trying to solve? Really important. And so this sits around the concept of what is your strategy. So you have to be able to articulate this to somebody who wants to invest. You have to be solving a problem. Good businesses solve a problem that exists. If you're not solving a problem, you're not differentiated, you're much less attractive to an investor. So give that one some thought. And we'll talk a little bit about what the components are of a strategy document later. So once you have established what your purpose is, what problem you're trying to solve, then you need to answer those two questions. And basically, you create initiatives, you create ideas and concepts of how you're going to address those two questions, which is how do you execute on that? What is your plan? And what are the initiatives you're going to do to answer that? And then the commonly known documentation that does that is a business plan. So you have the problem identified you want to solve, you then take that problem and answer that question, and the business plan is the execution of it. All right, requirements to be successful, a couple of points here. Clarity of your vision and your story. Really important to be able to articulate this problem and this answer. And one of the things I put here is investors like stories. They like a story, and they want to go on a journey with you. They want to be excited about this idea. You know, you're competing for this investment dollar. I'm Mr. Investor. I've got a dollar. There's lots of different places I can put that dollar. Why do I want to give it to you? You know, it's really important that there's a bit of excitement about it. Must be something compelling. Yeah. Other things to consider, as I mentioned, competing for the investor dollar. Really important concept to have. This is a selling document. These are selling documents. You're trying to ask someone to part with their money. So good strategy and a good plan to address it. The other one, which is one of my favorite concepts here, which I often see as a common problem amongst these sort of documentation I see, is answering the why and not the what. So really good video here that I want to share with you. And then I'll start by giving you my example. Do you want to buy this pen? And then we'll do the video because Simon Sinek does a much better job of explaining it, but here's my version of it. So one of my colleagues here has a pen. I pick up the pen and I'm going to sell you this pen. The question is, do you want to buy my pen? It's white with a green lid and it's about 10 centimeters long. It has ink in it. It's $2. Do you want to buy my pen? So that's the what. I'll have my alternate view of the world and go with what's the why. Would you like to buy my pen? It's a writing instrument. It lets you communicate with people on the other side of the planet and you don't need to be there. You can inspire people, you can make people emotional, you can make people cry with this thing, you can write law with this thing, you can change society with this thing, you can build a career with this thing. Do you want to buy my pen? It's $2.50. So the concept is selling is an emotional aspect as much as is a practical one. So when you're doing your strategy document, when you're doing your business plan, make sure you cover the why. All right, so that's my poor version of the why. Let's see a professional person who's, like I said, particularly good at this. It's a very short 5-minute video, which I'm going to put up for you guys. And then I'd love it if we can have a quick poll at the end to say, did you find it useful? Did you like it? Did it resonate? So, and the video's not coming up. That's a bit of a problem. Wow, I did the big sell job on the video and I'm having slight technical problems with that. So I'm going to have somebody look into that because it's not coming up. And then we'll have to come back to the video. Might do the video later on. If we can get someone to have a look at that for me. Apologies for that. We'll come back to it. All right, so you've done a really good job of your strategy. You've done a very good job of your business plan. the second question we have from Mr. Investor is, how much money do you want? And what are you going to do with it? So this is effectively known as the use of funds. So we need a plan to illustrate to somebody about what you're going to do with this money that you're going to get and why it's a good investment effectively. And there's two broad sort of strategies around growth or opportunities for spending the money. One is organic and one is inorganic. So you may use the funds to help grow your business by doing things like, you know, adding some more stock to your business, or enhancing the service offering you have by bolting on some extra services and hiring more people. That's more organic. Inorganic is the acquisition. So you might say, I need some money because I want to buy my premises, or I want to buy the business that's in the shop next door, and combine them together. The next point was around the special concepts around this is about sector familiarity. So interestingly, I see people come in all the time, investors to my business, saying, I want to buy a business. And I said, what sort of business would you like? And they say, I would like to buy anything, as long as it's good. And I said, oh, great. Then would you like something in this sector? Oh, no, not that sector. Oh, why not? Oh, I invested that previously and it went very badly. Would you like to invest in this? Oh, no, I don't like that sector either. So then the question is, what sectors do you like? Well, I made a lot of money doing this, or in my last job, in my last business, I did that. And what you find is people feel a lot more comfortable investing in spaces that they've either A, had a very positive experience from, or alternatively B, that they're familiar with. So familiarity and prior success are good aspects and good characteristics for getting someone to part with their money. All right. Next, so use of funds, really important, and we talk about this with the business plan. It's really important that you align the use of funds with your business plan. So if your business plan says, I'm going to double and triple and quadruple inside, or whatever happens to be, but your financial spend, or the money you're asking for, and then you put that to work, it doesn't match those words, you have a problem. So what we find it's really, really important here is that the financial aspects, the modeling that you do, it has to tie into the story. Yeah? So the best way to explain our use of funds is a financial model. So it's a little bit tricky for some people, but it's really important that you have a go. And again, we're going to walk through in the next section around some of the key documents and around financial modeling and how that works, to give you guys some comfort that it's not too scary. So some of the aspects here, we touch on them a little bit, but we will come back to more details, aspects of a good financial model and a good use of funds. One of the big ones is flexibility, and having assumptions that are believable. And yeah, I don't want to go into too much more detail here. We will come back to it. All right, so that's your second question. Third question for Mr. Investor. What do I get? Good one. So again, actually the best example of this, I think, is when I watch Shark Tank. I don't know if anyone else has watched Shark Tank. For some people it's enjoyable. For me, it's like being at the office. So it's not as good as, it's not as rewarding for me as it is for some other people. But it's a really interesting one. Someone comes in and goes, I've got this business, it's awesome, I need $2 million, I'll give you 5%. And then the Mr. Shark Tank guy goes, so what you're saying your business is currently worth? $20 million. I'm not sure that maths is right. But and then they have a really odd looking expression on their face, and then they don't get any money. So this is a really, really important concept, and really centers around valuation. It's really important for you to understand what you currently have, what your business is worth, what you're seeking to take it to the next location, and what you're willing to give up. I've got a little bit of an example here. Also really important that the money that you're asking and the risk that you're willing to take and the amount of equity you're willing to give in your business to somebody really matches the risk that they're going to take by investing in your business versus the reward that they're going to get from investing in your business. And there's two types of reward, and we touch on a bit here. and this capital appreciation yield. So I'm going to go into real estate agent mode here as a good example. So imagine buying a house versus buying a unit, which a lot of people do when they look at investing money to make money, investment property. So the concept of capital appreciation, you might go and buy an old house in one of these Perth's older suburbs where it appreciates in value quite significantly over time till it becomes a very valuable asset. But whilst you're renting it out, you're getting peanuts. So you're getting a very poor yield on the amount of money you put to work, but your asset is appreciating significantly in value. The alternative is you might go buy a brand new apartment off the plan. Now that apartment is unlikely to be worth significantly more. It will not match the capital appreciation yield that the old house in the suburbs might get, but your return on your investment, your rental yield, will be much higher than the house based on how much money you have to outlay to acquire it. So some people are looking to get capital appreciation from a business investment. Other people are looking for a yield. So retirees, they put a lot of their, they're another good example. They need to match their yield for their lifestyle, depending on how much they've got saved away. It's another good example, that concept. All right. The other one is a little bit around an investor. You talk about what do I get? Sometimes the answer is a job. Some investors want to be quite hands-on. They want to work in the business and be involved and take some responsibility for that growth in the investment. Others happy to give you a check and maybe visit once a month or once a quarter or whatever your arrangement you come to for them to feel comfortable that their investment is in good hands. So I just want to go back to the Shark Tank concept again with this pre and post money idea. So I've got a very short example, hopefully that makes it a bit more clear. How much money do I want? $1 million. I need $1 million to do my plan from Mr. Investor. What are you willing to give up? So again, I'm willing to give you 20% of my company or my business if you put $1 million worth of investment into the business. This tells me my post value money. So if you've given away 20% for 1 million, you therefore believe the remaining 80% on the same basis is worth 4 million, effectively your value of business today. At the end, you'll have $5 million business in that it has $1 million cash in the bank from Mr. Investor plus the existing business that you already had. Now, so pre-money today, when you're asking Mr. Investor to give you $1 million for 20%, what you're saying is I currently have a business I believe is worth $4 million, which is where a lot of our Shark Tank friends come unstuck when they ask for large amounts of money for a very small percentage of the business. And the investors look over those financial records and that strategy document and their business plan and say, no, thank you, that's not for me. All right. Which also brings us to our next one. Another little final passing thought before we move on. A percentage of something is better than 100% of nothing, which comes back to the concept, a smaller piece of a bigger pie might be more attractive than a bigger piece of a smaller pie. Anyway, enough of the anecdotes for now. Let's move on. When do I get my money back? It's a very good question. And again, one that a lot of people fail to address adequately, which is another reason why they don't raise money successfully. So somebody wants to know, I can give you my money. How much am I going to make? When am I getting my money back? What is your plan for getting my money back? So a lot of investors want to know how I'm getting out before I get in. So something that should be addressed in your business plan is the exit plan. And also what's the investment term? We spoke briefly about financial model. So really important that you incorporate into your model the return over time. So again, another very simple example, just going to tap my way through this one and explain it. So we've got back to the previous page, we'll bring that over. So we've got a $5 million business with investor A having 20% and the original entrepreneur having 80% with a $5 million valuation. So let's say, for example, things go extremely well, that money's put to work, you execute on that business plan, and the business is now a $15 million business, and you sell it to one of the competitors for $15 million. What happens then in 3 years' time? Effectively, Mr. Entrepreneur is $4 million. His 80% has now grown to $12 million. And Mr. Investor number one, he has gone from a $1 million asset to having a $3 million asset over a 3-year period. And of course, there's all sorts of extra modeling we can do around this, like return on investment. There's the appreciation that was made on the way. Maybe there was dividends. There's lots of other complications here. And again, the longer it took to get to $15 million, the less return on your investment you made. But effectively, this is saying over the period of 3 years, I tripled my money, effectively. Again, it's a bit more complication around it, but at least it gives you guys the concept of understanding the plan. Again, articulating this plan to somebody, saying that this is what you anticipate happening, you need a very good story and the numbers that go with it and support it. All right, so those are the big 4 questions. 3 times your money in 3 years. Good example. Do you need an advisor? So I'm very reluctant to come across as this is some kind of hard sell. It's not really the idea of this. This is an education 1 hour on investor readiness, not a hard sell. But what you really do need to know for you to effectively raise money is that you need a suite of documents, the strategy document, your purpose, the why, your vision, yeah, your business plan, how to address that vision, the execution points, how you're going to go about it, what you're going to do. Financial model. You need to demonstrate both the historical performance of your business as well as the future performance as to where you're going, what you're going to do with the money, use of funds, what the outcome is going to look like. Valuation. Really important to understand what your business is worth today, what it's worth after you've received your investment, and what it's going to achieve on exit. Market landscape. Something we didn't touch on too much now, but again, I'm going to go through it in a little bit more detail later. So each of these 5 documents, it's important that you execute these. If you can do these yourself, that is fantastic. That is what we want. If you can't, there are people that can support you with these documents. They may be friends, they may be people like myself, they may be lawyers, they may be other business owners that you know, or people in your community. But effectively, if you have this suite of documents and they are effective in their form, then you should have a positive outcome. All right. Strategy document. Again, can't teach you how to do strategy in 5 minutes, but what I can do is outline some of the things that you should consider when you're putting a strategy document together. At least you can have a go at it. So let's just walk through some of those things. Company values. This comes a little bit back to your vision and your purpose. You know, what are your non-negotiables? We have a very big sign here at BDO. It's plastered across the wall about what our values are. Things like we are human, we are one team, we strive for greatness, we are bold in our actions. You get the idea. There's a few more. I should know them all. They're quite new. Heart. Thank you, my colleagues. Let's care for our fellow colleagues and our clients. Important that you have those concepts covered off. It really matters to somebody when they're giving you $1 what you stand for. And it's not unusual for big businesses to, you know, that we see every day in our community to understand where they sit on this spectrum. Core purpose. Articulate the reason for why you exist. This comes back to something that we mentioned earlier. What problem are you solving? Yep, really important. Target market. Who are you selling your products to? Who are you selling your services to? Who are you selling them to today? Who do you want to sell them to in the future? It's a little bit towards market opportunity. Yeah. So you maybe currently have a business that's a hamburger stand in a regional town. You might want to open up a home delivery service, and as a result, you are reaching a whole lot of new people outside the immediate vicinity that currently drive past your hamburger stand. The idea is that you want to broaden your target market. You may have a business that you are selling feed for for people that breed cattle, you may want to start selling them fertilizer. So you might want to go for product line extension, that sort of thing. Yep. Your promise to your customer really is sort of a bit of a blend of a couple of the other things that we've spoken about here. What's the inherent promise that comes with the product and service? Clarity around what the customer needs from your product and service. So really important here that you take an opportunity to differentiate. You know, you might be selling on price. You might be the home brand of fertilizer in your market. Alternatively, you might be the Rolls Royce, and not a cheap product, but a very expensive product that does something very specific. Maybe you can increase people's yield on their crop by 30%, okay, and you charge it accordingly. But really important that people understand what you're selling and your positioning of your product in your business. Again, something we just touched on, but positioning of the brand. Interestingly, we had someone come through tell us their perception of our brand is something that we're working on at the moment at BDO with our brand positioning about, does it resonate? Do people think of us merely as their accountant? Will they understand the full depth and breadth of the different service offerings from tax to advisory to cyber to M&A to business services, audit, what have you? If your logo's not capturing that, if your materials aren't capturing that, you need to work out a way of communicating that to the market, to your clients and potential clients. One of my favorites, point of difference. Yeah, one of the things I look for, in clients that I take on for mergers and acquisitions, always looking for number one or number two in a market. Really important. And those people got to number one or two through some point of differentiation to everybody else that does what they do, be it through some sort of innovation or some sort of technical difference or securing a customer base that no one else can match. Really work out on a way as to why somebody chooses you rather than your competitor. It's really interesting when I ask the question of a lot of my clientele, why does your customer choose you? And quite often I have to challenge the answer because a lot of people don't know. So it's one that I really encourage you to think about and even ask your customers, what do you like about us? Why do you choose us? Yeah, makes sense. Since I brought up the why, and some very smart people from my technical team have now sorted out the video, we are going to have another go at the video because the video answers the why question. And so I'm going to share that with you. So hopefully, here we go. See if this works. Please bear with me. Hello, can we hear me? Awesome, we're back. Now let's go back to sharing screen. Okay, let's go to sharing screen. Cool, all right, we're back in business. So I love that video. I'm not sure how many people have seen that before. There's like a 1 hour version of that if it really floats your boat, but hopefully in 5 minutes it gives you a little bit of a idea. Much better version of my do you want to buy my pen? Explains the logic a little bit better than I can, but there you go. So what I'd like to do just quickly, because I'm really super curious, I'm just going to run a quick poll about who found that interesting or who thinks they can now take this back to their business and look at it in a different way, and that's going to feel like that's going to add some value. So did you find this useful? Launching the useful poll. Here we go. So hopefully that comes up on your screen. They came for just a quick yes, no. I liked it, I didn't like it. And since you can't see my slides, I can't really move on. So I'm just going to leave this open for another 30 seconds and we'll close it out. All right. Okay. All right. So about half of you voted. Give you another 10 seconds to click on yes or no. 2/3 of you voted. All right, I think we'll wrap it up there. And we'll close that one off. And so the outcome of that was 90% of people thought that was useful. Great. I think that's probably better than I was hoping for. So good result. Yeah, Simon Sinek stuff's freely available on YouTube. You can go and watch all of his stuff if you like it. But hopefully that kind of makes the point around the why. So you want somebody to part with their dollar. It's an emotional as much as it is a sensible. Yes, you need to have financials and things, but the story, the strategy, the business plan, really, really important stuff to do. So let's get back on track, shall we? Strategy document. So again, now this strategy document, in light of the Simon Sinek video, you can see a little bit more around values and purpose and why it's important. All right, let's go to the next slide. Business plan. So you've established your vision, your why, your purpose. Need to execute on it. So I've just thrown up here a really quick example of a business plan or an information memorandum style document that we had. This is one that's been slightly cut down from one of our smaller transactions we did, just to give you guys some ideas about the kind of things you might want to put in your business plan. So you've got your introduction, the highlights of your business. I'm going to touch on that again in a second, so let's come back to that. The opportunity, your product range, how it might grow. Clearly people investing for growth. Nobody invests in a business going sideways. Also, you may have steady state growth or accelerated growth if you want to get really, really excited. And also returns. Capital raising process, outline a little bit about, I'm looking for this much money. It's open for this amount of time. And this is the amount, again, back to the idea of, $1 million, 20%, that sort of thing. Description about your business. I find the timelines are a really fun thing to do over a bottle of red or a bottle of beer, whatever your preference is, just to sit down and go work through the history of your business. It's amazing the things that pop out and great for people to reflect on where they've come from and what they've achieved. An overview of your business, your purpose. That one had farming equipment in it, this particular one, which was particularly relevant. Manufacturing standards, sales, model, suppliers, premises and lease, all very sort of more your what, something in that section. Growth opportunity, if it's national, international, maybe it's state, maybe it's suburb, could be whatever it happens to be. A bit about your products or your services, depending what sort of business you have. Again, your industry and your competition. And again, I'm actually going to talk about that one in a little bit more detail in a couple of slides time. So I'll come back to that one. Key management, really important to know who's in the business and what experience they've got. We have one at the moment where it's a rather large business, people are exiting, people are really curious about what the next level of management down looks like. The fact that the next guy down's been there for 35 years gives people a lot of comfort, know what they're doing. Financials, again, historicals, combination of your historical and your future. Also, it's really important to know what your cash flow is. So profit's one thing, but cash in and out is another one. Really depends around your capital expenses and your depreciation, how big your asset base is to make your return. Finally, a bit about your systems and so on. Snapshot here, really important, which I identified at the start there. Opportunity, highlights, and investment opportunity, which are the first two things in the introduction, and that is a snapshot is basically why I want to buy your business or why I want to invest in your business in this case. Yeah, I tend to like to do a page with 9 boxes on it. I find this is a really fun technique where you basically try and convince somebody to invest in your business in 9 boxes. Yep, it's a really critical slide. And one of the things I find that people do wrong when they're doing this is they do that first. You can do it first, but you should also do it last. Quite often we find when we're presenting a business that during the course of preparing these materials, the things in the 9 boxes change. So it's really important that you come back at the end and it is the last thing we do. Yeah, we challenge, constantly challenging what are the 9 strongest points. And then there's a little box there of things to consider that you might be your 9 strongest points. Who are your key clients? Future revenue that you might have secured, growth opportunities, demand, key management, selling points. You get the idea. Track record. Do you have partnerships? Strength of your team. Your best financial metrics. Yep. To give you a bit of an idea. So something we've touched on previously and I want to go into a little bit more detail on is a financial model. So there's two things in a financial model that really matter, and I'm going to cross them off here. Let's go with the first one, is the inputs. Yeah, when you're building a financial model, it's really important to create a set of assumptions. Yeah, really important to have assumptions that you can also flex, things that drive your business. And again, something you should challenge. Sometimes people don't quite know what the driver of the business, what the unit of business is. It could be what you think it is, it might not be. It's really important to sit down with somebody and challenge what you think it is. But the key assumptions, effectively, you create like a base load of assumptions, which is what you think is the normal or the base load or the scenario, and then it's nice to be able to flex it. Yeah, you got to answer the what if question. So if someone says, oh, if I add 2 new staff, I can do 5% more. What if I had 20 staff? Oh, you might blow it up. I don't know, might be awesome, but somebody's going to ask. So if you're building a financial model, you're driving it off your assumptions, it's really important that you can flex them. Yeah, flexing them lets people understand your business and what it can be. Yeah. The second part is for all the accountants in the room, and that is the calculations piece, or the engine room. Great to put assumptions in, but the mechanics have to convert your assumptions into workings. Yeah. So something that, as an investor, typically they don't get too fussed on this. Yeah, provided someone professional has prepared it, someone knows what they're doing. Yeah. Then for me, the important part is the inputs, and the next bit, which is the outputs. Yeah. What you're measuring, what your key KPIs are, your key performance indicators, dashboard, a summary, something that says to somebody, if you put in this machine calculation, out pops this. Yeah. Investors really key on the inputs because they're saying, do I believe this? Is this sensible to me? Secondly, outputs. If that does happen, is what comes out the other side attractive enough? Yeah. Really important they understand how much goes in, how much comes out. Awesome. Moving on. How are we going for questions? Still any questions of note? Okay. All right. I'm going to move on. I'm not saying anything with particularly burning. All right. Valuation. Again, something we touched on. Valuation, actually, remarkably, is actually be surprised to know that there's a bit of art, there's a bit of science in valuation. There's actually lots of different purposes for evaluation and lots of different types of valuations. So evaluation may be, I'm getting divorced. What's the value of my business? Yep, we see that. We see valuations for a bank. Yep, if a bank's going to put money in, what does this valuation look like? Valuation for investment, well, it really depends if you're the buyer or the seller on that one. You know, you can pump it up if you're the seller, as long as someone's believing it, that's a good thing. Yeah. So you've got to understand lots of different methodologies, discounted cash flows, EBITDA multiples. For those of you who understand that, driving off, whether it's driving off the returns that you're making, whether it's driving off the strength of your balance sheet, all these things matter and affect what your valuation looks like. As I mentioned, third-party valuations add more comfort. So if you're taking a value of your business and you're going for debt, you need some debt. If you take a valuation from someone who's prepared, who's a professional, and you go to your bank, say, I've had Mr. Professional value my business, I've valued my kit, value whatever it happens to be, you get a lot more comfort from that. You're going to get a better result. This is again, hopefully this is the most compelling point on valuation. The big risk with not getting this done or not nailing this is the opportunity cost for it being out, either over or under. And again, back to my friends on Shark Tank. If you pitch too high, if you haven't had somebody professional look at it, you may just blow up a qualified, interested investor. You know, the guys on Shark Tank that make it through, the guys that are sitting there ready to invest, they want to invest. They have money. They fundamentally like the idea. If you don't know what your business is worth, if you do something outlandish, it says, I don't know what I'm doing, you lose credibility. Investor, good chance you lose your investor. Equally, if you go in there and you've invented Facebook version 2, everybody thinks it's fantastic and wonderful, and you say, all I need is $1 million for half the business, you've just shot yourself in the foot. You've just given away massive amounts of equity that you did not need to give away. Yeah. So for what is a relatively inexpensive proposition, valuation, there's serious benefit in getting some help. Final piece is you need to understand your audience. It comes back to Mr. Investor about who he is and who they are, who she is, and where they sit relative to the rest of the investor universe. So we have this concept of what is my business worth to the man on the street versus what's my business worth to somebody who benefits greatly from it. So quite often we think of that more along the trade sale and the selling point of view. So everybody knows in the bush that the person who's going to pay the most for your farm is the guy who's got the farm next door. There's immediate synergies. They can move their equipment. They don't have to travel. They might not need a management team. You can have one homestead. There's all sorts of reasons why they can pay more because it costs less to run and execute that business. Now, the other way to look at it is to say, okay, if it's worth $100 to the man on the street, it's worth $150 to my neighbor. How much is my neighbor going to pay? If the answer is 150, he's giving away all his upside. There's no incentive for him to execute on that. There's no great benefit paying 150 to you. Where there is benefit is if he pays 120. You're getting $20 more than the man on the street would get. He's getting $30 of instant synergy. Yeah, hopefully that makes sense. So find an investor who brings skills to the table. Find an investor that may have a business that's synergistic in their portfolio. So we've got a question, it's a good one. Is it reasonable to attribute value to blue sky? It's a good question. So let's move back to the idea of valuation. A really, really common concept is the idea of a multiple. It's used quite a lot in investing and capital raising. So that is that your business is worth whatever your EBIT or EBITDA or whatever your profitability number is, times it by a multiple. Yeah. Multiples typically dictated by a combination of the industry and other businesses that are in your industry and other transactions that have happened and the relative value of your business or the attractiveness of it. And that drives the multiple. So we talk a bit about blue sky. If you've got a business that is tracking at $6 million a year and next year is going to make $6 million and next year is going to make $6 million, if you're looking for a multiple on that, there's no real growth in that business. There's no blue sky. Therefore, the multiple you pay might be 4 times multiple, 3 times multiple. If you have a business that did 3 million, then 6 million, and it's going to do 9 million next year, yeah, you still might have a $6 million business. The fact this year, the same as the one next door doing 6 every year, but the fact that it's going to do 9 next year, you might pay a higher multiple on the $6 million. Same profitability, different growth outlook. You can capture blue sky, but you're capturing it through a multiple rather than capturing it through your profitability, so to speak. So I find people trying to use the blue sky aspect to drive their profit number. It's not really the profit number, it's the multiple. It's the capturing the blue sky through painting a picture that makes it more attractive to get the multiple up to make your business worth more. Hopefully that's answered that question. If not, please find me another one. Happy to talk further about it. We'll also do a Q&A at the end. So very happy to pile questions in. Those who want to save to the end, happy to do that. All right, 5th one, final one, market landscape. Really important to explain to somebody where you sit in the ecosystem of the environment that you operate in. And this is a one for the farming community. Mr. Forrest has a business that breeds cattle. He also has a backgrounding operation. He also finishes them, this nice brand new thing he's building in Mora. And then he has also got a processing facility down in Harvey that puts steaks into coals. So he's a guy that's playing in multiple ones. So he's in the center of the circle. You know, you might look at your business and say, well, where am I playing in my market landscape? Am I in multiple industries? Who are my competitors? Really fun thing to do is, well, fun for me, may not be fun for you, but important as part of the process is to understand who else sits in your circle. Which circle are you in? Are you in multiple circles? And then there may be people that are in and around those circles that, again, comes back to the familiarity or a history of success that says, this is a space where I play and I'm comfortable and I've made money. I'm more likely to pull a dollar out of my pocket and give it to you. So also important when you're explaining about where your opportunity is for growth, yeah, because we're talking about growth, investment for growth. So outline where the opportunity is. Is it moving into a synergistic environment to the one you're in? Yeah. So again, on the side, we've got Again, a bit of free speech there. Apologies for that. Let's get back on track with bullet points. Where do you play in your market? How do you differentiate from your competitors? Use this to identify, justify your exit strategy. So again, this is also really useful for that. It's a very good point, that these people are the people that you may or may not have in your exit strategy. As for how Mr. Investor is going to get his money back. Question number 4, how am I getting out? So this helps you with that part of that story. Things to consider, again, back to your growth, who else is in the market, the value chain, your drivers, your threats. Hopefully that makes sense. It's a really important document, concept, piece of work, should form part of your business plan. It says I understand my business. You know, people love investing in businesses where the people that own it understand what it's about and where it's going. All right, sources of fund. 2 key sources of funding for your growth, debt and equity. I'm going to touch on debt, speak a little bit more about equity. Debt is a little bit more straightforward. The banks, good old banks. Everyone loves a bank, but except for the Royal Commission, they don't love banks. So at the moment, banking industry is a bit of a tough spot. A lot of private businesses are finding it hard to raise money from their banks. Though all the banking people I speak to say they are well and truly open for business and are keen to hand over money to you. Perhaps if you go through this process and prepare some of this documentation, your bank will be more inclined to give you money than if you haven't been through this process. So whether it's debt, whether it's equity, very worthwhile to go through and prepare those suite of products. Touching a little bit on their onerous requirements for finding risk aversion, given some of the things that have happened recently, people are finding it difficult. Of course, this has created, well, every action has a reaction and the market has reacted. The result is the pseudo bank or the family fund. There are a remarkable growth in this sector in the last few years. Things like Judo Bank, all these online banks, no presence, any kind of physical presence, but funded by combinations of overseas money and family funds. And these people are a little bit different. I think my view is they've historically been a bit more open to investing on a risk reward continuum. They might invest in you when a bank doesn't, but the rate may reflect the risk that they're willing, or their perception of the risk that they're taking. And also there's, again, back to this sort of structural idea of bank just going and getting a loan, a little bit more open to some convertible notes and options and some alternate products which have debt and equity like attributes. Something that we've done here historically. Convertible notes have been quite a popular alternative to help bridge that equity and debt gap. So there's a few notes on there about how those work, but you should consider those. Equity. And this one was the one which I would imagine most people thought we'll be talking about, so I'll go into this a little bit more. I wonder if anybody knows what the most common source of equity is for small, privately owned family businesses. Family and friends. That's where the money comes from. First person you ask is your mum, your dad. When they're tapped out, go to your brother, your sister, or your nana, whatever it is that is. If you need a couple bucks, it is typically the first place to start. And to tell you the truth, a lot of businesses and empires have been built like that. Mike Malone started IINet in his parents' garage, and I think it was a multi-billion-dollar public company. Tons and tons of stories. I'm sure the Apple story is not too dissimilar. I'm pretty sure those guys started in a garage too. Something about techie guys in garages, I don't really understand. But anyway, digressing, it's back on track. Families and friends, that's where you start. That's where most of the small businesses are funded, at least and get to a point until that is no longer an option. And we move forward from there. One of the next popular places is venture capital. So these are the guys that look at businesses that are, again, quite small still. It is, in my view, an expensive option. So typically you do not get large amounts of cash, but you do give away large amounts of equity. But some people, it is the only option, and sometimes they can be highly successful. So not something to be ruled out, but just eyes wide open. It is expensive as an option, but it may be your only option. And again, these guys sort of work on the basis this doesn't always work out, and but equally they bring some skills to the table. So it is an option, but like I said, expensive. Once the business has, if the business has matured enough to pass through venture capital and have a little bit more scale, you might attract high net wealth individuals or private equity. Again, a little bit more mature. Typically, you've got a business model that's working, functioning, and you've got maintainable earnings that are rock and rolling. What these guys love, they typically love, is a business with a very motivated owner with a very clear plan on what they want to do and where they want to go, and they've got all the ingredients except for the cash. And again, hopefully a lot of you tick those boxes and you are preparing those materials to illustrate that that's the bucket that you sit in. Now, there's a few private equity firms in Perth, and there's a lot more on the East Coast. Again, it's a bit of a game of matching. So each private equity firm is just like any other investor. They have areas they like and areas they don't, and quite often it's based on previous experience or exposures that they've had. So it's really important that you find, if you're going this way, or a high net wealth or a private equity, you find someone that's aligned with you, understands your business and your industry, and will support the plan. The final one's strategic buyers, and I would be remiss not to mention it, but clearly it's a little bit more outside the scope here, and it's back on the idea that you're looking to exit more than you are grow your business for investment. So it's more your crystallization of everything you've achieved at the end, the opportunity for you to walk away. Now, saying that, it is not 100% every case a strategic buyer has to take 100% and you walk away. It is just a large majority of the time. Yeah. Okay. Recap. Something that, Sarah, did you want to jump in and go through that? It's the 4 main points. No, maybe she doesn't. I'll take that. So this revisits back to the objectives at the start. I just wanted to make sure that these sort of came through and resonated. So capital raising is different to selling. Different type of audience, slightly different type of materials, slightly different outcome. Yeah. Remember, people, when you cap raise, are investing in you and your story. When you're selling a business, it's them and their story. Yeah. 4 big questions. Hopefully everybody remembers what they are. Support the answers with materials. Yeah. So once you've got your answers, write them down. Finally, source the right funding for you. Take those materials to the right group of people, whether it's equity or debt. So I'm pretty sure I've used up my time allowance now. That's pretty much the end of that. Hopefully people found that useful, interesting. We do have Q&A. I'll leave it open for a minute or two. If people want to jump in with questions, very happy to answer them.
While we're waiting for the Q&A, I'll jump in. Thanks, Todd. That was excellent. I think that gives us something to think about in being prepared for the kind of things that investors will expect when they're looking for capital. I have one question for you, Todd. Is there anything that you, in your experience in mergers and acquisitions, that you see common that people are missing, or is a recurring issue when people are trying to raise capital?
Sorry, I was reading questions. Sorry,
okay, I'll repeat my question. Is there anything that you see that's common in your M&A experience that comes up with a lot of people or a lot of the clients you experience that's just a common issue that is repetitive? Or something they're not prepared in? Or does it vary?
I think the big one is those materials are really important as we walk through. Sometimes people say, I don't need your help. I've written a business plan. I've got my financial model and I'm away. Just introduce me to the universe of equity investors. Quite often, the materials that people prepare won't get the job done. So whilst we really appreciate that people do it, we prefer that people, if you want to get us engaged and involved in the processes, having thought about it, have a go at it, do collect all those materials and those ideas, but then work with somebody who does it for a living to actually refine them so that you get an outcome that works. Ultimately, if you don't get there, then it's not a good outcome.
Excellent. I don't know if we have any more questions coming through, but This webinar will also be uploaded to the BDO website should you want to view it again and really dive deeper into the 4 questions investors want answered. The next webinar coming up is Danny, which is in 2 weeks. And if you're interested in filling in the gaps and looking at the hygiene factors that Todd mentioned in the beginning of the webinar, you can register for this through the BDO website. Do we
So
have one,
just
Todd?
before we sign off, there was a couple of questions, and one of the ones was, will the slide pack be available? I believe that we will make that available. So anybody who's looking for a copy of those slides, very happy to share them. And another question was separating the asset from the business and the valuation. So again, owned or leased, it is an important question. A lot of my clients typically own their premises, but we do separate the 2 concepts. A lot of people actually have the operating asset and the infrastructure separate through superannuation fund or something like that. So what I typically see is maybe someone owns a commercial property and they lease it to the business. The business records a rent or lease payment every year. It's important that that's at arm's length. So just like you basically create a third party effectively for your infrastructure asset, and then the business has an expense equal to a commercial rate to use that property. And then an evaluation on the operating business is done on the basis that that rent is being paid, and whatever the profit and performance of that business is what it is. If you would want to sell your infrastructure asset, it is a separate price, just like you're buying off any other third party. Yeah, and then people can look at that and make a judgment on that. It's a completely separate transaction, really. It's what is the rental income, what is the capital appreciation, what is the yield. Somebody will make a decision. Quite often we'll see people that have a third party or related party infrastructure asset that they'll negotiate as a part of buying the business revised terms. So they might want extended options over a time period with renewals. Equally, they may want an option of first refusal if the property or the premises are ever sold. Another one, conversation on ownership, partnership, and having all in tune. Yes, tricky, really important. You pick your investor carefully. As much as they are picking you, you need to be picking them. Really important that you guys can get along, guys and girls. Otherwise, it doesn't particularly work out. Really, really, really important to establish the ground rules up front. Shareholders agreements is something I highly recommend. It helps you understand mechanisms for what happens if things go wrong. So plan for the worst, hope for the best. Assume it's going to go terribly when it comes to preparing a shareholders agreement, so that you are prepared and there's mechanisms and everything's understood up front. So look, start as a startup, any particular corporate structure better or worse than others. So look, tax can drive your structuring when you're in a startup mode. You need to speak to someone of that. But from an M&A point of view, typically a company is always my preferred structure for investment. Much easier to transact shares. I've seen unit trusts and things sit behind that. It's not really very good from a corporate point of view. But again, you need to weigh up with some tax advice about the impacts of your structuring, because the company isn't necessarily the most tax effective in an early stage, but it's really important as you mature a bit, and if you want to raise money from an investor. So get some advice, look at where your business sits in its life cycle, when you plan on changing or raising your money, how far away that is, and then you go from there. But I would hope at the point that you're talking to me about raising money, that you would have a company structure. But again, go speak to your accountant. We've got friendly people here at BDO that can no doubt help you with that if that's something you're looking at.
Danny will also be talking about that next week. In the next webinar in 2 weeks, we'll be touching on the different structures and how they impact your investor readiness.
One more question. We'll do one more before I close out. I was looking at capital and generational risk levels. So succession planning is something that comes up. Hopefully this is my interpretation, this is right. Quite often the next generation don't have the funding and the capability of taking out the parent. So again, it can be problematic. Really important that you come up with a plan for that. Equally, quite often the second generation are very well equipped to be able to take over the management of the business, but sometimes the business just is a victim of its own success. It can grow too big. So you can use a combination of structuring, where maybe it's a purchase over time. Maybe you can find multiple family members. Maybe it's a situation where it's a partial exit, and then for retirement, so that you can fund the first generation or the more senior generation into a lifestyle that they're looking for retirement, and the second generation can continue to operate the business. But it is not without its challenges, but it can be done. The secret is good planning, good communication, and a commercial outcome, so that everybody has a win. Cool.
I think that's it. So
Excellent.
thank you for your time, Todd. Thanks everyone for listening in. And if you do have any questions about the Investor Readiness Program, please reach out either to myself or the Department of Primary Industries and Regional Development. Thank you.
Thanks, everyone. Cheers.